Now let's talk about the persistent model in
Okay.
detail,
Okay.
because that's the prime focus.
Yeah.
So, how did you come up with this, and how long have you been living with this framework?
So, see, I told you I have been investing for about 15 odd years now
Hmm.
and mentoring for longer. And I've noticed that successful companies have certain things in common. Right?
Hmm.
For example, all of them have a model which is scalable. For example, all of them have an entry barrier which they keep enhancing and which therefore ensures that competition is kept out. Right? All of them are solving a problem for some customer and the customer is willing to pay them. And on the other hand, I saw unsuccessful companies, they also had certain things in common. For example, many of the unsuccessful companies had no entry barrier. वो जो मैं कर रहा हूँ वो 50 लोग भी कर सकते हैं, आराम से कर सकते हैं. And not just today's competitors, it is potential competitors. Right? Or many of them were non-scalable. And when I say non-scalable, I would say that they were so heavily dependent on manpower. And when you are heavily manpower dependent, you cannot scale rapidly because you cannot suddenly absorb huge numbers. It messes up your company. You can't get so many people, you get bad quality and so on. So I saw a lot of common things happening. And these were there in the mind somewhere, in the subconscious somewhere. And then when I started writing the first book, I think I started writing in 2018, if I remember right. Yeah, it came out during COVID, so 2020. That's where I said, boss, there are all these bits of learning which I have. So, for example, you should be solving a problem. Otherwise, you don't have and the customer has to be willing to pay you for solving the problem. Is there a simple way by which I can get founders, potential founders to remember this? And then I started thinking, I put these down, I played around with words, I kept changing words. And that is how this persistent, it was not a one shot thing. I kept played it. So P was obvious, solving a problem. E is very obvious, entry barrier. S is very obvious, scalability. Some of them were not very obvious. For example, I, it took me a long time and then finally I said, okay, I is innovation. So it took me a long time, but finally I was able to get all these common things which are required into a framework. And the good thing is, persistent itself is a good word.
Yes.
Because you have to be persistent. If you look at that perfect attitude, persevering is the same thing.
Yeah.
आप persistent नहीं हो तो आप तो मर गए. So it took me time, but it's based on all the successes and failures I've been seeing.
And you always apply this framework, or when you're making investments, sometimes there are exceptions?
Yes, I do. Not only I do, Lead Angel also uses it. I would say every investor uses it, irrespective of where he is, except that he'll be using different terms. So, for example, I use the term entry barrier. Many people use the term moat. Same thing, right?
Yeah.
Ultimately, the concepts are the same. It is the same thing you have to apply. So, it's not that we have created something completely new. It is just that we've put into a simple format which you can easily remember and apply. Good practices which have been there for a long time. So we basically put good practices into a framework.
So even before you started investing in startups, you're already investing in stocks in public markets, right?
Yes.
So do you think some of those lessons from equities listed companies are also some learnings are also applicable to startups?
Okay, yes, I would say some. And again, I'll use the persistent framework. But there are some differences as well.
Yeah.
So, for example, the P is still the same. You have to be solving a problem for somebody. Earnings model is still the same. Size of the market has to be high. Scalability can be different because, in the internet world where you have most startups, scalability means the ability to grow very rapidly.
Yes.
Right? But in the conventional world, which is where you have most listed companies, scalability just means the ability to grow big. So Hindustan Lever is a highly scalable company by that logic. But if you look at this environment, it is not scalable because their growth is, their growth in volumes is what, 7-8% per year? That's peanuts.
Yeah.
Right? So there are some differences. There are some of the other areas, for example, I talk about risks, I talk about innovation, applies to everybody, completely applies to everybody. Traction applies to 100% to both categories because, and in fact, if you look at in the listed world, in the world of listed companies, traction has to be much, much, much higher.
Yes.
Because otherwise, how do you get investors? Whereas here, even a much lower traction would work. So, certain things are common, certain things are different. But overall, I would say the model still applies because ultimately it's a model which is built for successful companies.
Yeah. I also have a couple of acronyms which are my favorite.
Oh, okay.
So one acronym is it's called ESL. So what kills a business? It's ego, speed, and leverage.
Okay.
I recently learned it.
Okay.
And second is just decomposition of DuPont, which I just keep recalling from my earlier days as an analyst. Asset turnover, margin expansion, and leverage. Okay. So if the business startup goes to 100 CR, then how do they expand their margin? What happens to return on assets? What happens to leverage? So I always think from shareholders' value perspective. So
okay.
So because I am buying the dream,
right?
Which is that someday this will be a 100 CR revenue business, not valuation.
Correct.
So at that point, how does your margin expansion stand?
Right.
But
Kulmani, some of these may not be valid in these early stage companies. For example, you said leverage, right? अब लोन ही नहीं मिलेगा तुमको तो कहाँ से leverage लोगे? But once you get into that position, see, ultimately, whether you are listed or not, ultimately all companies have to follow these metrics. So ROC is very important, return on assets is very important, return on equity is important, leverage, everything is important, debt equity ratio. But that happens, I guess, when these startups become much more mature.
Yes.
So it probably applies to these huge companies like Naukri and Zerodha and Co. Sure. But not to start, not to early stage startups.
And so if a founder checks all the boxes on the persistent model, and they start thinking of getting funding, right? Because like you mentioned in Earning Corn, you should get funding for growth, not for survival.
Correct. Right? Yes, absolutely.
Not to pay your regular expenses, but for...
Although I'll just clarify, at an early stage, sometimes you have no choice. For example, if you're running a B2C company, you have to spend money on marketing. And at that stage, you have nothing. So at that stage, you need that money. Now, whether that money comes from you or from a grant from the government, if you're in biotech or something, or it comes from investor, you still need the money.
Yeah.
But after a point, it has to be for growth, not for survival.
So even in, let's say, D2C kind of a model, how much from an investor's perspective, what kind of burn do you think is acceptable?
Okay. I don't think there is, I think it depends a lot on the field you're talking about, right? So, for example, if you look at, let's say, AI-based businesses.
Yeah.
Frankly, in the investor's mind, I think it reminds me a little bit of the year 2000 when investors said, boss, internet hai, paisa dalo. Okay. Today it is AI hai, boss, paisa dalo. There is a FOMO, fear of missing out.
Yeah.
So these are companies where, frankly, investors are not looking at burn because there is no revenue.
Yeah.
Possibly all you've got is a paid pilot, maybe 2 paid pilots, maybe not even that, you've just given a demo and you are asking for a hefty valuation of maybe 30, 40, 50, even 100 crores. So I don't think there is any number. It depends on what it is, but I would say from an investor point of view, anything which seems to be the future is much more likely to get money and typically at a higher valuation and you'll have less conditions than anything which is much more conventional. So I'll just give you a simple example. There is a guy who is I've been mentoring, and he basically runs a toy business around toys. He says, I identify chota manufacturers who make toys, new toys, and then I make them available to distributors and some retail outlets in typically smaller towns. So it's a I think he's at break even right now.
Okay.
And therefore he'll become profitable. So burn nahi hai. But I don't think we'll be interested, or any investor will be interested, because it's a very, very conventional business. Investors need that excitement, that thrill. अरे यार AI है, बॉस चैट जीपीटी देखो कहाँ पहुंचा है, AI में डालेंगे पैसा. So I think it varies very much depending on what area you're talking about.
Yeah. That is what is commonly now known as inflection. So there is a theory called inflection theory. Inflection is different from insight. Inflection is basically the founder is able to see the future, and in the current, he wants to reach that future state, right, but he's able to break the pattern of a business model.
Yeah.
So that is the inflection of future in the current.
Okay. And, and in any case, Kulmani, investors who invest in startups, particularly early and middle stage, are risk takers. You know, the guy who's investing in the stock market is not a risk taker. I mean, he will, assuming he's not investing in penny stocks. Right? Normally, if he invests, let's say, Nifty companies, Sensex companies, there's no risk. Yes, there will be temporary downturn, but overall, the Nifty and Sensex have only been going up on an average. Right? So risk taker nahi hai. But these companies, in any case, they are risk takers. They are willing to take risks. The only question is, which area am I willing to take a risk in? That toy platform for toys. If it is such a conventional business, I don't know what kind of growth I get. Why should I take that risk? Whereas AI, it may collapse. But if it does well, it could, grow 10 times in 1 year. So that is risk I'm willing to take.
So you have to compensate for that risk.
Yes, exactly.
So a higher multiple exit.
Exactly. See, in any case, you've been in this business for a long time. All investors know that out of 10 investments they make, maybe 8 will fail. One will do brilliantly, hopefully, and one will be tick, or 2 will be tick, right? So that one who does brilliantly has to compensate for the losses in those 7 or 8. And therefore, when he invests, he looks for potentially very, very rapid growth and scalability.
This is the power law. Little bit of portfolio management also. Thinking is required.
Exactly. And ultimately, it is excitement.
So, on that burn rate and growth, I remember listening to Alok Bansal from Policy Bazaar last year at one of the events, and he talked about the law of 50. So he said, if you add your EBITDA margin and your growth rate, if you get the number 50, then your burn rate is acceptable.
Oh, okay. So I wasn't aware of that.
Yeah. So if your EBITDA is minus 70%, then your growth has to be 120%.
Oh, so good. I've learned something today.